Welcome back to the channel, guys. So in today's video I wanted to cover Netflix. So Netflix is a stock that's been down quite a bit in the last couple of months. So if we look here in the last 6 months, it's actually down almost 30%, year to date 8%, and then just before earnings, or actually right after earnings, it dropped as well, because the market didn't like the outlook of them spending more on content. But Netflix, I think, is a solid opportunity right now. So I wanted to cover the stock, go over, let's see here, the Q4 report, then do a SWOT analysis, which I think will be good for this one. And then finally end it off with a bit on valuation as well. So without further ado, let's jump straight in. In terms of the Q4 report, they did beat on earnings and revenue. Netflix reported specifically 45.2 billion of revenue, which is 16% year-on-year increase to last year. The operating margin came in at 29.5%, up 3 points. And then the ad revenue did rise 2.5x to over 1.5 billion. And then the Q4 specific revenue came in at 18% year over year. And they reported that they crossed 325 million paid memberships during the quarter as well. And then operating income rose by 30% year over year. So in general, really solid earnings. Where they did fall down, or what the market didn't like, was the extra spending that would be coming in Q1 of 2026. But their Q1 of 2026 forecast is still pretty good. So they expect year over year growth of 15% compared to the Q1 of 2025. And then the operating income will increase, operating margin increases as well, net income increases, and then diluted EPS also increases. So pretty good as a whole. In terms of shares outstanding, they do mention that they will be pausing their share buyback program to fund the WBD acquisition. So here in the Q4 report, they say we first prioritize reinvestment in the business, both organically and through selective M&A, while maintaining liquidity and then returning excess cash to the shareholders through share repurchases. Consistent with that framework, we'll pause our share buybacks to accumulate cash to help fund the pending acquisition of Warner Bros. So as we can see there, that's something to note with Netflix as well. They'll be pausing their main way of returning value to the shareholder, which would be their share buyback program, and that will be to fund the WBD acquisition. In terms of their growth going into 2026, they do expect revenue to come in at the end of the year around 50 to 51 billion, which is pretty solid. So it'll be 12 to 14% year over year growth. And then they expect their ad revenue, which is one of their new kind of drivers of revenue, to double in the next year as well. So right now, I think they mentioned it was at 1.5 billion, so that will be at around 3 billion in the next year. At least that's what they expect, and they've been pretty accurate so far at predicting their earnings. And then they also mentioned that operating margin is set to increase as well to 31.5%. Moving on to the SWOT analysis, I thought this would be a pretty good way to have a holistic look at the company. So in this type of analysis, we look at the strengths, the weaknesses, the opportunities, and then the threats that affect the business as well. So jumping into the first one, it would be the weaknesses. So the first thing would be that the cost of content production, aka their main spend. This is a weakness if it keeps increasing at a high pace, and then them not being able to offset that with higher margins. So the way Netflix is right now, I think they'll continue to increase the content spend, and that will bring on new subscribers, but their margins should increase at the same time. So I don't think this is too much of a weakness, but it is something to be aware of. The effect of the acquisition on the balance sheet would be the next weakness. So if the acquisition for WBD does go through, that debt will be reflected on the balance sheet straight away, and that will definitely weaken it a bit. But I do think Netflix are fully capable of financing that and paying it off with their free cash flow. So I don't think the WBD acquisition would be much of a weakness for them as well. Onto the strengths of Netflix, which speaks to their moat as well. The first one there being their global scale, which allows them to spread the cost of production over many users. And that kind of leads on to the next point, the scale of economy flywheel, or more their content flywheel, I should say. So, them being able to spread the cost of production over many users, they can produce more content, which allows them to attract more users or more subscribers, which then funds the creation of more content, which continues that cycle again. So that's a pretty big moat for Netflix. That keeps them ahead of the competition. They can spend a lot more on the content, which will attract subscribers. The next thing being their brand equity value, which no one really mentions, but Netflix has become a big brand name. So when you think of streaming, you think of Netflix. It's a similar thing with fast food. Like if you think of fast food, you think of McDonald's. I think that's an intangible value that's very precious. And then the final thing that I don't really hear people talking about much would be the robust technology infrastructure. So Netflix has proven that they can support so many subscribers, streaming content all the time. And then with the latest live events that they've been having, they can also um, support the streaming of content at the same time for live events as well. So that bodes well if they go into sports more fully in the future. They do mention that they will be streaming the World Baseball Classic series, which I'm not familiar with, but the live events will become a bigger thing over time. On to opportunities. Netflix's total addressable market is still pretty big. Although they do have 325 million subscribers, the US market is mature, but the international market still has a lot of room to grow into. In terms of their advertising business, they're still in the early stages of that. They do expect it to double, as we've said before in the Q4 report. They expect it to double this year, and I think the margins on the advertising business are going to be pretty high, so that will flow down to the bottom line. And then the other opportunity would be the WBD acquisition. If they do manage to close that, then that's a lot of content that they will be able to include, a lot of premium content series such as Game of Thrones, Succession, and then IP like Harry Potter and things like that. Though that's huge IP that they can get their hands on, and they'll also be removing a competitor in the streaming space as well. So that is a big opportunity for Netflix there. In terms of threats, the regulators are pretty much the biggest threat when it comes to the acquisition. It does seem that they're locked in with WBD to complete it from that side, but if the regulators do block that acquisition on the basis that Netflix would become a monopoly, that is a threat right there. And then there's pricing pressure. There's definitely a cap to how much they can charge in the future. Although I think they do still have pricing power. Once they do hit a certain point, they might start churning users. So I think the focus should be on attaining new subscribers and increasing the advertising revenue, and squeeze out as much growth in that direction as possible rather than always just relying on increasing prices. And that's pretty much it for the SWOT analysis. I think it gives a pretty good holistic look at the company. In terms of Netflix, I think the strengths far outweigh the weaknesses. And once we look at the valuation, we'll see that the balance sheet also is pretty good. The acquisition of WBD, if it does go through, will affect the balance sheet, but I think they can take that hit and continue moving on. Okay, so on to the exciting part, the valuation. So Netflix right now trades for $83. Their PE ratio for the trailing 12 months is 33, next 12 months of 27, and then the 2027 PE sits at 22. As we can see from their revenue, it's a beautiful chart of increasing revenue. So they've grown at 20% year on year in the last 10 years. And then it's kind of slowed down in the last few years. Now it's 15%. Next year, as we saw in the Q4 report, it's 12 to 14% expected revenue. So it is slowing down. The company is maturing. If we look at the total subscribers, they did hit 325 million, as they mentioned in the latest report, and I expect this to continue growing with the expansion into international markets. So I think we'll see steady growth here, although not as fast as it has been. If we look at the content budget, it's staying at around the same region here. It is expected to go up 10% in 2026. So it'll increase a little bit, but it's going to stay quite flat, I think, for a while, maybe in the 20 billion region over the next couple of years. And then if we look at the net income, also nice increasing graph over here, up and to the right, up 56% in the last 10 years, and then up 26% in the last year. So solid right there. And then the free cash flow has been steady for the last couple of years. They do expect this to increase as well. So it should do well there. And then they'll be using this free cash flow to pay for the WBD acquisition, which they expect to go through. The EPS is also growing quite nicely. So 56% in the last 10 years and then 27% in the last year. And it's still expected to grow decently well, in the high teens at the very least, for the next 5 years. Their cash to debt ratio is not bad. So 13 billion in debt and then 9 billion in cash. And then this is going to change drastically if the WBD acquisition does go through. Their ratios are all pretty good. They're all increasing. So return on capital is right now at 30%, which is very nice to see. The gross margin is also increasing for the last couple of years, sitting at 48% right now. And then the operating margin is also growing, sitting at 29.4%. So overall, the balance sheet looks quite good. If we want to do some DCF calculation, I looked at what the revenue and earnings per share could look like in 5 years, and it did come close to what the analyst estimates were. So I'm just going to use their estimates for this. So this is a screenshot from the estimates on the IBKR platform or Interactive Brokers. So analysts in 2030 have an average estimate for EPS of 5.8, and now it's at 2.5. If we use those estimates in our DCF calculation, it does come about to 18% EPS growth rate. And then if we give Netflix a multiple of 25, which would probably be my base case, we can see that the stock price could reach about $140 by 2031. If we increase the multiple a bit more to be more in line with what it is now, so let's say 33, you could see that you can double your money by 2031. But my base case would be the 25 multiple. So in terms of verdict on Netflix, I think it's a solid company. If you're buying right now, you'll probably get a really good return in the next 5 or 10 years. For me, I'd like a higher base case return. So I'm staying out of this one, and I'm preferring other options to this. But I think it's a company at a fair price right now, and you wouldn't go amiss by jumping in at this point. That's pretty much for this video. Thanks for watching, and I'll catch you in the next one.